Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are going to take a somewhat unexpected pivot here, perhaps, and give a little bit of a different perspective to the kind of economic data review that we usually do. So we do a lot of looking at economic data and what it means and how it factors into the market's thinking. And today, we're going to take a bit of a different tack for how to tactically use or not use economic data. Because indeed, where the data doesn't have an impact can be just as telling as where it does. And so what we're going to do here is have a look at how you can, with the benefit of non-reaction and not influence from economic data, get some important directional signaling about overall sentiment in markets. And what presents us with this lovely opportunity today is a bit of economic data from Australia and Japan. And so what we can do is actually compare how this data might influence on the Australian side, how it might influence on the Japanese side, or not. And what that tells us then that influence is or isn't there. So let's consider first the Australian case, then we'll go to the Japanese case, and then we'll put it all together into what could be a very helpful indicator if, as many of us around the markets are doing now, you're trying to figure out global recession odds, global recession risk, how much do the markets care, how bad of a business downturn are we looking at, and in general, what does the global business cycle even look like, and where is it trending in the minds of investors writ large. So, Australia first. We have April's jobs report on the table later on today. It's going to be coming out evening time, U.S. hours, early a.m. for Australia. That'll be a slowdown, according to baseline expectations, from 53,000 net jobs added in March to 25,000 in April. Jobless rate seen holding unchanged at 3.5%. Let's not worry about the Japan numbers for now. We'll get back to those momentarily. Looking at what has been the course for Australian economic data. Here is the City Economic Surprise Index. This is a gauge that we use to look at how data has performed relative to baseline forecasts. Those forecasts coming from a plurality of market economists that's usually compiled by the likes of Bloomberg, Reuters, other big data aggregators that put these things together. And you can see here that, first of all, Australian economic data has been improving a bit lately. Let's call it since the start of February or so, and is now cautiously starting to outperform relative to forecasts more often than not because the index has gone back above zero. You'll notice, though, that the overall trajectory over the past year, year and a half has been down. Now, does this then suggest that we should be looking for a reaction function from this data if it surprises on the upside, as has been the direction? Well, if we look at monetary policy expectations for Australia, we can see that the markets are at this point positioned for absolutely nothing in this space through the rest of the year. So if we consider the greatest likelihood for a policy change. We have a 50% shot at a rate hike somewhere between August and September. So you can see in the number of hikes cuts column, in August and September, there's half of one that's priced in somewhere in there. And you can see in the implied rate delta column for the corresponding months, we've priced in about 13 or 12 basis points of a 25 basis point move. So the markets are about 50-50 on maybe we'll need one more hike at some point later. And that's the most hawkish that this gets. In other words, the markets are completely locked in despite recent data moves and recent improvements in the numbers. They're completely locked in to standstill with a very, very narrow chance or maybe a hike. But as you can see, the odds are either right on the line at 50% for August or just below better than even, slightly worse than even at 48.7 for September. Now, that could move if there were a significant surprise in the data. So is that something that we should be angling for? Well, looking at how Australian economic data has behaved relative to the price action, we can see that the Aussie has been incredibly impervious to what should be supportive news. So we can see here, as the RBA rate hike cycle starts, Aussie keeps falling. As you get reopening from COVID restrictions in China, Australia's largest export market and biggest source of external demand, you have a bit of a relief rally that's already underway in broader markets. That continues, but there's really no discernible acceleration, no big positive reaction as China relatively unceremoniously, with quite a bit of surprise, decides we're going to scrap these COVID lockdowns. We can see here, again, relative calm in the face of the SVB-led banking crisis, certainly as relative to the US dollar. And again, no reaction barely at all when at the very last RBA policy announcement, there was a surprise rate hike. Markets didn't expect it. The RBA hiked rates all the same. The range has continued to hold. So the Aussie has not been able to take what would, under normal circumstances, be considered positive economic news and turn that into positive price action development. And that is largely because it has been increasingly anchored to industrial metals. What you have here is the Aussie dollar in the orange and industrial metals in the dark bluish gray there. So what you're seeing is seemingly an Aussie dollar that's increasingly tied up with what is Australia's biggest export commodity sector, which is industrial metals and fossil fuels. Coal is a big one here, but really iron ore and other industrial metals are the biggest chunk of what has been the driver of Australia's success as a mining exporter. What you're then seeing is seemingly a parallel reflection of easing demand for these things. You'll notice very tellingly that you have industrial metals really start to head lower and really start to pull the Aussie with it as the Fed's rate hike cycle gets underway. So you can see the peak here right around the first quarter of last year. The Fed, of course, begins its tightening cycle in March. So what you have here seemingly is more a barometer of global growth and of optimism or pessimism in this case about the global business cycle as the fundamental driver for the Aussie, because surely if there is a global downturn, it is likely to show up in input commodities that go into the creation of goods that are then consumed by a growing economy or not consumed by an economy that's decelerating. You should see that show up in the inputs early, ostensibly, because businesses foresee that there will be a downturn, or at least anticipate some degree of it, and start to scale back at the front part of the supply chain to ensure that as demand slows, they are not oversupplied and inventories are not overstocked. That, of course, would be a money-losing proposition for businesses. And so what seems to be occurring is this sense that as central banks tighten, the global business cycle will slow. That will impact demand in general. Where you should see that show up first is in raw material inputs, in so much as Australia derives much of its growth from exporting those raw material inputs. You then have an outsized sensitivity for Australia at the start of a business cycle downturn, which then crimps scope for rate hikes and necessarily undermines demand for the currency. Not surprisingly, then, the Aussie has been relatively impervious to what's been happening on the domestic front because this larger narrative appears to have fully subsumed what's going on, making the Aussie, as it often does, once again behave like essentially a proxy for the global business cycle. Indeed, if we take a look at how this correlation between the Bloomberg Industrial Metals Index and the Aussie has evolved relative to what's going on with the expectations around the business cycle that again, a preponderance of market economists have. Again, this is a broad Bloomberg survey. You can see that as recession odds appear to rise, now hovering around 65% in the US, the correlation builds. The correlation was declining, and then as those recession odds started to rise, it started to go higher, elevated as those recession odds increased, and is now hovering at higher levels. So we can see here that as recession is the topic of conversation, the Aussie is more sensitive to metals and less sensitive to its domestic news flow as such. So it's not so much the data that we would expect to have an impact, and to the extent that it would be relatively in line with expectations and not a dramatic surprise, it should not have too much of a lasting impact because its reaction function for monetary policy in Australia is limited, and therefore its reaction function for the currency ought to be limited, because the currency is essentially the risk-on side of a global business cycle coin. Now, let's go back to economic data and refocus on Japan. Here, we're expecting to see a pickup in inflation. April's CPI report expected to go up from 3.2 to 3.5% year on year on the rate. We'll call this medium core, a term I've completely just made up, excluding fresh food, seen going up from 3.1 to 3.4, the more traditional core measure excluding both food and energy, seen going up from 3.8 to 4.2. So we can actually see here that food and energy in particular appear to be disinflationary forces. So inflation is higher when you take energy out of the equation. Inflation is a little bit lower when you take only food out of the equation. And so food does seem to be a bit of an inflationary influence, and that's consistent with soft commodities being a little bit higher in recent weeks, whereas energy commodities are not. This, of course, speaks to the idea that Japan's inflation is primarily imported, which we'll touch on in just a second. But you can see the expectations here, seemingly, for an inflationary pickup across the board. Now, if we look at the surprise index for Japan, we can see it's looking a bit different than did Australia. Here, we're looking at a bit of a deceleration. And actually, economic data seems to be starting to do relatively worse relative to expectations. After a period of downswing, it is now below zero, which suggests that data has now a slight tendency to surprise on the downside. That would imply that maybe there's some downside risk in these CPI numbers. And then were this to be a central bank other than the BOJ, we might have a conversation about, well, the inflation target is 2. We're going to come in maybe surprise on the downside here relative to expectations. So maybe we end up with the low 3s on a headline number. And if the direction of travel seems to make sense, then maybe what we get is something like a more dovish view of the BOJ outlook. But it is, in fact, Japan that we're talking about. And so that kind of thinking somewhat goes out the window. Notice that if we look at what's baked into Japanese policy expectations, it is a whole lot of nothing. There is not even a 10 basis point margin of change in this outlook. So you have a very slight probability of a rate hike sometime toward the end of the year. So you can see things starting to look a little bit more constructive. 6 basis points out of 10 that you would need for a hike baked in by December. So very, very narrow and really amounting to a move just out of negative territory, which of course is quite the setting for interest rates, given inflation is about double the stated target. So what's going on here? Is this inflation data going to really motivate rates one way or another? Well, doesn't seem like it. And this is why. This is the very long-term chart going all the way back to the early 1970s of what's been going on with Japanese inflation and interest rates. Interest rates there, the longest running single Japanese baseline rate, the BOJ discount rate, going all the way back to 1973. Japanese CPI here year on year. Don't get stuck on the units. The numbers have been normalized so that we can show them in 2 dimensions clearly. But what's important here is the direction of travel. What you see is that for decades, you have had a steady decline in Japanese inflation, which has not surprisingly come alongside a steady decline in Japanese rates, which now sit at zero and have sat within a hair of zero basically since the early 1990s. So we're talking the better part of 30 years here. And that this has continued even as in the early to mid-aughts, the Bank of Japan embarked on a dramatic monetary easing effort to try to juice this inflation setting higher. So in the yellow here, you see the Bank of Japan balance sheet as a share of Japanese GDP. So you can now see that the Bank of Japan owns in excess of 100%, frankly, in excess of 120% of the entire economy's size in assets, in an effort to try to generate enough monetary stimulation to get inflation higher. And you can see that it has not been able to do it for 30 years. Inflation has just been idling in a range, basically since the early 90s. So any kind of near-term economic data considerations really don't factor very heavily, it would seem, because we seem to be on neutral for inflation here with no real sign of change through all kinds of different economic cycles, with some episodic increases, some episodic decreases here and there, but broadly standstill, even as the Bank of Japan has bought more than the size of the entire economy in assets to try to get this moving. Well, naturally, the question is why? And this seems to be the answer. What we have in the orange line here is the year-on-year growth rate of Japan's working age population. You can see it's been slowing for decades, and as of the recent years, has actually gone negative. So Japan's working age population is at this point shrinking. Now, what this means is that Japan is losing people in its population mix that are at prime age for consumption. When people are working, this is their accumulation phase of life. This is where they're generating household growth, accumulating assets to support those households, going on vacations, educating their children, accumulating assets for retirement. As you get this demographic shift in the labor market, what you're losing is spenders. And so, not surprisingly, you don't have a whole lot of inflation generating economic activity, because an increasing share of the population is moving from the spending years into the drawing down of savings years. And so, not surprisingly then, as you age the population, you lose capacity for inflation to really gain momentum, and then you've effectively, as a consequence, pinned rates at zero. Now, what's interesting is that in this environment, the yen has been hardly at a standstill. The yen is one of the more active currencies. So it's clearly not changes in relative monetary policy, at least from the domestic side, that animate it. But changes externally are. So you can see here in the red is the Japanese yen future, that's 6J. And in the dark line, there is an average of US, Eurozone, and UK 10-year bond yields. And what you can see here is since the start of the yield recovery out of the depths of COVID. So from May 2020 onward, we have a rebuild in yields as the initial sort of risk aversion of the pandemic's outbreak starts to wane. And of course, the process accelerates significantly as the rate hike cycle begins last year. And you can see that in almost perfect inverse of that development, the yen declines. This is in large part because of what we see here. Interest rates in Japan are pinned at zero. The yen was the worst performing currency last year because it is the one major currency, I should say, the worst performing major currency, because it is the one where there were no rate hikes. The US dollar was not surprisingly the best performing because it had the most rate hikes at 425 basis points. As global interest rates rise, the opportunity cost of owning assets denominated in yen deteriorates, whereas the opportunity cost of owning assets in currencies that are higher yielding starts looking more attractive. It starts to make sense to borrow cheaply in yen and buy assets that yield more with that borrowed yen. Because you're effectively paying zero on the borrowed yen, but you're earning on whatever assets you buy in whatever currency yields more, or whatever asset yields more. Doesn't have to be a currency. And that ends up being an attractive development, not just certainly for Japanese investors, which can natively borrow in yen, but global investors too, which can go to Japanese banks, borrow for essentially nothing, and redeploy capital elsewhere. What this then means is that the yen is essentially a creature of global bond yields. The global bond yields are a creature of risk aversion or risk appetite. What tends to happen when the markets are defensive? Capital goes to bonds. When markets are feeling relatively well supported, relatively chipper, capital comes out of bonds and goes into risk. Yields are, of course, inversely related with bond prices. So in a risk aversion scenario, capital tends to move such that yields decline. In a risk-on scenario, capital tends to move such that yields rise. So what we end up with is a situation where the yen becomes a kind of anti-risk barometer. The flip side of the global sentiment coin that the Aussie dollar sits on, and with its correlation to industrial metals. And so where we land then is comparing these two currencies against each other gives us a good barometer for what is the risk appetite setting of markets writ large. Here is that spread. This is 6A versus 6J futures spread. You can see, not surprisingly, that since a spike during the outbreak of COVID in 2020, we've been building higher. We reached a high of 98.32. That's the peak last year. And what this is telling us is that the Aussie is outperforming the yen, which means that we are on the mend from a business cycle perspective, and also that interest rates are on the rise. So yields are going higher. The Aussie is going higher. The yen is going lower. This is telling us that not so much even the stock market, because of course the stock market was down last year. It was undermined by these rising yields. But that the business cycle itself, the global economy, is in a relatively improving phase because the costs of borrowing are being squeezed higher, and indeed, economic activity seems to be improving, which would, not surprisingly, as we've discussed, benefit a cyclically minded currency like the Aussie. What you then also have are the makings of how one might spot the beginnings of a downturn. So you can see the trajectory broadly defined by this kind of loosely drawn upward sloping channel here, defining series of higher highs and higher lows on this move. That seems to have been violated. We don't necessarily have confirmed reversal yet, but one might argue that if we got under 85.75, the immediate support level for this digestion range that we're in now, then we'd be looking at something that looks more like this barometer exchange rate has turned a corner, where the yen is starting to outperform the Aussie. That would be consistent with the deteriorating outlook for input commodity demand at the same time that yields are declining, which is why the yen is doing better. Its relative yield disadvantage would then be reduced, and the impetus to sell it against higher yielding assets would be reduced. Sure. And that can be a very telling early sign, well before stock markets have rolled over, that the global business cycle is at this stage declining. We haven't gotten there yet. In fact, as we can see here, we're idling, which seems to suggest, as we look at bonds, as we look at stocks, as we look across a whole range of assets, that we're waiting to see what's next. That the initial business cycle influence of the COVID recovery has run its course, and the markets now wait for what is the next shoe to drop. And if we were to get back over 92 and indeed over 98, we might be looking at reacceleration in the global business cycle. But if we then, as we say, slip under 85.75, then perhaps it's the other thing that we're looking at. Either way, this sets up as a very straightforward way to say, what's the market think the global economy is going to do? Is it going to grow? Is it going to improve? Or is it going to deteriorate? And that can be very helpful to trading pretty much anything, as you like. With that, we'll wrap up today's edition of Macro Money. As ever, we are here Monday through Thursday, right after overtime, with friend of the show, Chris Vecchio, head of Futures and Forex here at Tasty Live. On that show, Chris and I discuss that day's events and try to contextualize them within the trends across major asset classes. I'm also on with Chris for Futures Power Hour on Fridays, and on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, I'm opining on Twitter at Ilya Spivak. We'll be back tomorrow. Thank you very much for joining. Happy trading.